The worst labor market in decades. Yesterday's job opening and labor turnover report has some surprising findings about the state of the U.S. jobs market. So, some people are saying this is the worst labor market in decades, going back even to the GFC. There's a ton of conflicting data. We're going to do our best to dive deeper than the headline data that you will hear reported on the nightly news. Here we can see unemployment level 7.6 million. Well, job openings came in above expectations right now at 7.7 million if you round up. So now we do have job openings above unemployment level. A lot was made a couple months ago about the unemployment level drifting above the job opening level. That has reversed. And by the way, all these charts are going to go back to 2001. It is normal to have the unemployment level above the job opening level to a large degree, by the way. So the anomaly was really having job openings above the unemployment level, not the other way around. We are still in a low hire, low fire environment. 5.1 million in terms of job hires, 3.1 million in terms of quits. Should be noted, by the way, if you take the unemployment rate and invert it there, that is generally correlated to the hiring rate. They are inversely correlated with each other. So now diving a bit deeper, a job opening level, of course, 7.7 million, but job openings as a share of the labor force came in at 4.4%. Now, that is notably above the historical average. Again, this is as a share of the labor force. Now, a lot of people say that a lot of these job openings are fake. I don't have personal experience with that, but I do believe that millions of people saying the same thing, which is all these job openings appear to be fake. I think that there should be some weight given to that. If you look at job openings relative to job quits, this is a proxy for labor market tightness. Higher means that obviously there are more openings, more job openings that are not being acted on. And sure enough, what have we seen over the past couple months? Job openings have increased far faster than quits have. Now, moving on here, I want to point this out. I pointed this out months ago, 13 charts that show that we just came out of a recession. In that video, we looked at job openings. We looked at the rate of change, not just the headline figure, but the rate of change of this underlying metric here, the 12-month rate of change. And what I want to point out is that we are having a very characteristic kind of cup formation handle being formed there. And generally, you see that coming out of a recession. So the rate of change of job openings tends to decelerate as you are coming out of a recession. We have just started to go positive on that particular metric. Again, no recession was declared in 2022, but is looking more and more like we actually did have a recession. Arguably, many sectors of the economy are still in a recession. Now, looking at quits, the level of quits, 2.94 million as a share of the labor force, this is actually relatively low compared to the historical average, except in the post-GFC world, of course, coming out of the GFC, 1.7% as a share of the labor force. Now, if you look at quits relative to layoff, quits divided by layoffs, what this ratio tells you to some degree, it's a proxy for the amount of leverage that workers have. And unfortunately, for the average American, worker leverage has been decreasing. If you look at quits relative to layoffs are increasing faster than quits are. And of course, that indicates employer leverage. Now, looking at the hiring rate, of course, again, we're in a low hire, low fire sort of environment, although layoffs have started to tick up. If you look, for example, at the Challenger Grain Christmas job cuts report, which we did a video on if you are interested. Looking at hiring, 5.1 million. If you look as a share of the labor force, 3.01 million, this is very low compared to the historical average. So again, the headline figure might look okay, but once you look at it relative to the historical average as a share of the labor force, which is arguably way more important than just how many people are being hired, the headline figure, looking at it as a share of the labor force, and you can see that we are pretty low compared to historical average. averages, really, except for the GFC. That was really the only time that this ratio was lower. Now, hires as a share of quits, hiring divided by quits, this has been increasing, meaning that hirings have been increasing at a faster pace than quits have. I want to point out that generally speaking, at least going into 2008, that is the same sort of trend that we saw going into the GFC, which was hiring was increasing at a faster rate than quits were. Employees sometimes feel economic weakness before the employer might. And so maybe that is an explanation for that particular metric. Hiring divided by openings. Now, this is the fill rate. This is that efficiency of how many openings, how many of these potentially fake job openings actually lead to hiring. Now, as you can see, that is almost at an all-time low. I will remove a couple of the other metrics here so that we can see very, very clearly. I think, again, that there is some truth to what people are claiming, which is that a lot of these job openings are indeed fake. Why have openings increased at a faster rate than hires to such a degree going back to the GFC? I think it is a valid question to ask. Now we're going to look at layoffs, discharges, and total separations. Now, right now, layoffs and discharges, as Challenger Grain Christmas have noted in their layoff report, we can see that that is starting to curl up and potentially go parabolic. Of course, that is what happens going into a recession. We are getting an acceleration in layoffs and discharges, although still relatively within the historical average, lower than the pre-GFC sort of economy. If you look at total separations, those are at 5.05 million. That is well within the historical average. However, layoffs as a share of hiring, this is a good metric, a good way to look at labor churn. Job destruction versus creation. If layoffs are surging and hiring is not, this green line will go up and to the right. And sure enough, that is what we have been seeing going back for the past couple years. We have seen layoffs increasing at a faster rate than hiring. Remember, with the relative chart, all these relative charts we are showing, if the numerator is growing faster than the denominator, the line will go up. If the denominator is growing faster than the numerator, the line will go down. Now, to finish up, here is total job openings, that first chart that we showed relative to the S&P 500. Of course, this was my chart and it ended up going viral. And I think it's worth re-pointing out that AI and productivity enhancements are going to take jobs. We know that. We know for a fact that that is already happening and likely to accelerate into the future. So we are increasingly living in a disconnected, kind of almost neo-feudalistic sort of economy, where, traditional metrics, especially from the goods economy, say 20 years ago, look at Dow transports and look at freight cargo shipments and these sort of traditional economic metrics, I think are increasingly becoming less useful as we enter a world where 5 companies are propping up the entire stock market. 5 companies and their capex, when it is in regard to AI, is increasingly what is keeping GDP positive. 5 companies and spending hundreds of billions of dollars on that AI capex. What is the purpose of it? The purpose of it, as Rick Reeder, Chief Investment Officer at BlackRock and potential next Fed chair, pointed out, the entire purpose of AI is to reduce headcount. Now, companies have been generally kind of restructuring. If you look at the reason for the layoffs in Challenger Grain Christmas report, restructuring is the prime reason. Doge, downstream Doge effects, and of course AI are other highly cited reasons, as are economic uncertainty and tariffs. But I think that the AI unemployment tie or link, that AI job displacement that is arguably already here and only going to accelerate. I mean, again, that is the entire purpose of AI, is to improve productivity and replace humans. I think we're going to increasingly live in a disconnected world where traditional economic metrics do not really matter. I mean, we know that the bottom 50%, arguably bottom 70% of Americans, maybe even 80% 10% really do not matter. In the aggregate economic sense, consumer spending is being propped up by the top 10%. We have a K-shaped economy, not only in wealth inequality, record, even more than the Gilded Age, by the way, not only record wealth inequality, but we have record inequality in terms of consumer spending, in terms of within the stock market. You know, you look at the Russell 2000, the equal weighted S&P relative to the market cap weighted, right? There is a K-shaped economy in more ways than one. And I think that we're increasingly entering a new regime, a new sort of era where traditional economic metrics matter less and less. And it raises the question, how are we going to navigate that economic reality, that economic frontier in front of us? Arguably, is not going to be very pretty. So also, if you stay till the end, thank you very much. We appreciate it. But I want to thank everyone. We crossed 30,000 subscribers. So I appreciate everyone's support. Really, really appreciate it. Just trying to provide value for folks. So glad to see that we are successful in that manner. So anyways, hopefully that was helpful, and I'll catch you in the next one.